So in this video, I'm going to share with you my plan to build a £100 million property portfolio in the next 3 to 5 years. We're going to go into the goal, like what is the goal here, give you a short bio on myself, kind of introduce myself and my background, explain why I'm doing this and documenting this, kind of a high level overview of the strategy, like a 30,000 foot view, current progress, where are we at right now on this journey, reverse engineering the goal. What does a £100 million property portfolio look like over 3 to 5 years? How do we make it work? A couple of the mental models I'm thinking of, and then what I call the 3 bottlenecks. So kind of understanding how do we really unlock this level of scale and how I'm kind of thinking about building this business. Now, this video is going to be kind of very high level, like I say, a 30,000 foot view, but in future content, we're deep dive into what's working, what we're working on, more technical sides of different parts of the business. But for now, this is just a brief introduction to this mission that we're starting. So the goal as it stands right now is to build a £100 million property portfolio within the next 5 years. So that would be by the 1st of June, 2030. For those that don't know who I am, or a bit of a reminder, a bit of a bio. The family business is a state agency. Now, when I say family business, it's not a business that the family work in, but my parents run an estate agency business. They have done my whole life. So I've kind of been exposed to entrepreneurship. That led me to start kind of a couple businesses while I was at school. I tried the clothing brands, events business, learning to trade Forex, e-com drop shipping and everything in between. Didn't get any of them to work, but decided at 17 years old, I didn't want to go to university. I wanted to explore entrepreneurship, starting my own business. And that's when I saw a Facebook ad for a free property seminar in London. I'm originally from the Midlands, so I took the day off school, got the train down to London. And at 17, that's when I was exposed to the world of property investment and wealth creation through property. Ultimately left school, started working in sales myself, and eventually did my first deal at 19, which was an £85,000 house in Coventry that I bought from a motivated seller, flipped, made a 30-something thousand pound profit. I've got a video on my other channel kind of breaking down the deal. Sometimes I get the numbers mixed up. Bought it with a 10% deposit, refurbed it on credit cards and borrowed money. That was my first exposure to just the importance of being resourceful, one of the most valuable skills you can have in property. For those that know, main businesses, actual kind of a real estate agency, which I'll talk about, and a consulting business we have. And as it stands right now, we're building £9 million worth of property at 28 years old. So let me explain why I'm doing this, why I'm documenting this, why I'm creating this video. So the first reason I want to document this is for accountability and transparency. By putting this out there into the world, I'm putting my back against the wall and making myself accountable. And I want to do this transparently. I want to build in public. The great thing about property, unlike maybe if I was building a company around a specific product or service, is that there's an abundance of opportunity for all of us to win. And by me being successful at this, it doesn't take away from anyone else and vice versa. So I can build in public and share everything transparently without worrying about others competing with me, etc. I want to share the lessons and inspire others. I feel obligated to share the lessons I learn along the way, the lessons I learn from people that are ahead of me, that are around me, etc. And if I can just inspire just one person from documenting this to think bigger, go out, believe in themselves, and have some success, then all of this is worth it. I'm a believer that time is the purveyor of all truths. Some argue there's a few fakes and frauds in the industry. For me, I just respect the man in the arena, those that are putting themselves out there in public, taking risks. But ultimately, time is the ultimate purveyor of all truths. And so we can look back at this video in 5 years from now, and we can really see who's about it, who's not. Playing small does not serve the world. I tell a lot of people, playing small doesn't serve you. your family, those around you. You have an obligation to explore your full potential. I also believe that attention is a currency. So later in this video, I'm going to talk about the importance of creating media and content as part of this journey. But in the new age that we are in, attention is a currency, and there's a huge amount of opportunity that comes downstream from building attention, building an audience of people that know, like, and trust you. And ultimately, I want to do this with no regrets. I've never met anyone that regretted documenting their journey, but I have met a lot of people that regret not documenting their journey. And ultimately, what's the worst that can happen? So that is why I am doing this. So let's look at the kind of high level strategy. So in terms of the type of deals that we're going to be doing, I'm going to focus on conversions. So an example of that could be buying an office that we are converting to residential to HMO. So commercial property converted to HMO, or residential property converted to HMO, for example. The reason for this is favorable planning policy. So in the UK, the planning policy as it stands is just way more in favor of conversions with permitted development and Class MA. There's also lower risk, specifically lower construction risk, because when you're building ground up, there's a huge amount of more variables that come into play with the construction. A lot more things that can go wrong, and so that inherently brings a lot more risk. And the second difference between conversions versus ground up is that of the total cost stack of a project, the construction cost is a much smaller percentage of that total cost when doing conversions. So you're not massively exposed to the construction element of the deal. And if you look over the last 3 to 5 years, like it's been up and down, the whole construction game with build costs, etc. And I think a number of years ago, I don't know if it was over COVID, that there were more construction companies that went bankrupt than any other industry combined. So for us, it's really just mitigating risk. And then the third benefit we see of conversions is quicker turnarounds. How long it takes to convert an existing building into something else is a lot quicker than building something from the ground up, which is good. We're going to focus on developing high cash flowing assets. So right now, primarily that's going to be HMO, houses of multiple occupation. So for those that are unaware, it's properties where they're split into individual rooms that are rented out individually. Now, the HMO market is changing, and there is a lot of hype and a lot of people moving in the direction of social housing, supported living, etc., which we don't want to say we won't do, but primarily right now the focus is HMO and apartments, and things will iterate. Like ultimately, I'll talk about this in a second. This business plan you see now is probably going to be different to what it looks like in 2, 3, 5 years, and that's okay. We're open to iterating and pivoting as the landscape changes. We're going to focus on value add only deals. So we're going to be buying deals where we can add immediate value or buy at a discount, ideally both, but we want to be buying at a discount and or creating an uplift in value, the opportunity to add value. A couple of reasons for that. One is it allows us to create that new equity, that uplift, that profit. And in return, the returns to investors and funding partners we work with, or the return on cash being deployed, is juiced up, which means attracting capital is a little bit easier. It makes the deals a lot more attractive. The plan is to refinance and retain all of the projects. We don't want to buy a project that we wouldn't want to keep long term. And the plan is to then recycle capital through deals and then focus on larger projects. Now, when I say larger projects, larger is subjective. Some people, large project is 10 million, 50 million, 100 million. So what I mean by larger projects is kind of 500K to £1 million GDVs. I actually think the average GDV as it stands right now is going to be towards the top end of that range. We've got a couple deals in our acquisition pipeline right now, which are closer to actually between 1.5 and 2 million GDV. But what I don't want to do is try and build a £100 million portfolio made up of £100,000 buy-to-lets in the north of England. So for us, this is kind of a really nice sweet spot. In terms of current progress, so as it stands right now in the delivery pipeline, developing a site over in a small village in Cambridgeshire called Isleham, which is for 17 houses. That's 12 open market high-end homes and then 5 affordable homes. It's about 28,000 square feet of property in total. And the projected GDV is around or just over £9 million. In terms of what's in the pipeline that we're acquiring, well, since the start of the year, we've kind of been going out, making offers and starting to progress things through legals. We've got around £4 million of GDV across multiple projects. But for the most part, in fact, all deals that we've done prior to this, we've sold and not retained, which is something that I just kick myself for. It's a big mistake. If I go back in time and tell my 19-year-old self that having £50,000 in a bank account might make you feel rich, but it's an illusion. Real wealth is actually having £50,000 in a property that goes up in value each year, pays you an income every single month. So having it kind of sitting in their bank account is nice when you open your online banking on your phone, but it's the illusion of wealth. But lesson learned. In terms of reverse engineering the goal, I mean, like I say, this is very high level, but with an average GDV of £500,000, we would need to be acquiring 3.33 deals per month over 5 years, which is a pretty high cadence, pretty high frequency. Now, it's possible, and I have people in my network, friends, that are kind of ramped up to that level of frequency for acquisitions. An average GDV is 750k, that's 2.23 deals per month. An average GDV of $1 million, that's 1.67 acquisitions per month. I think we're going to be somewhere between the two here. So maybe in the short term, the goal is to kind of ramp up to 2 acquisitions per month. But like I've explained already, the plan is to iterate. Like, I'm open to the idea that the business plan, the model, the things we're doing now might be different to what we're doing in 2, 3, 5 years. And ultimately the business will compound each year and eventually will hit an inflection point. So if the plan is to do this within 5 years, I don't necessarily expect that 2.5 years in, we're going to be halfway towards our goal. It might be a case that actually the last 12 months, the last 2 years of this 5-year stretch is when we do the majority of those deals, because we'll have a bigger team and better resources and have made mistakes and learnt lessons, etc., etc. So that's something that I'm very cognizant of. In terms of other things I am thinking of, well, first thing I wanted to do was obviously form a clear business partnership. So I've pretty much always had business partners in the deals that I've done, because I believe the right partnership creates a 1 + 1 = 5 dynamic, where the output of both of you together is exponentially more than what it would be both of you kind of going out individually combined. Now, the key to finding a good partnership, in my opinion, is you have to look for 2 things. And that is, you want complementary skill sets where your strengths are their weaknesses and vice versa. And then you want shared vision and values. So for me, my strengths is kind of capital raising, finance, strategy, media, branding, social media, acquisitions as well with my estate agency background. But my weaknesses is I can't hammer a nail in straight. I am lost on a construction site. Now, obviously, I've been in the game long enough to kind of understand what's going on a construction site, but I'm not someone that's grown up on building sites, and it's not something I enjoy doing either. So construction, project management, and then also time is a constraint for me. This is very much a side business. My main focus is growing my real estate brokerage, the consulting business as well. And so for me, I want to make sure that my time and the things I'm doing in this business is highly leveraged activities like creating media, capital raising, etc. But I realized that the best partnership for me is having someone that can commit full time to this and is someone that really understands the construction and project management side of things. So partnering on these projects with a friend of mine called Jamie. Jamie's background is in civil engineering, had a very successful civil engineering business, working on multi-million-pound contracts, both with engineering and construction. And he's committing full time to this as well and has skin in the game. So he's going to be really helping me on that side and creating that 1+1=5 dynamic. I also have an idea and a framework that I share sometimes called the perfect property business. And that is the understanding that property investment, property development is very capital intensive. It's always a lot of money going in. And yes, it does produce some cash flow, but that's not the primary objective of property investment development. The primary objective is to build equity, to build wealth, to build that balance sheet. And with that being said, like, I'm someone that, probably like most people watching this, I want to live a nice lifestyle. I want to be able to go drive the cars I want to drive, go travel to the places I want to travel, look after the people around me. And to do that, you need income, you need cash flow. And so for me, my main sources of income and cash flow are my consulting business, which is Property Ed, where we help property investors and developers either raise capital and get into larger development projects, not just with me, but with a great team that I work with and partner with, and we work one-to-one with our clients. And then our real estate brokerage, LPP, which is where we specialize in the marketing and sale of luxury property, £1 million plus property, all across the UK, but primarily in the south, kind of Oxfordshire and below, and now into prime central London. And I've got a team of talented brokers that represent the brand there. And so this means I don't need to bleed the business by drawing an income. I'm not dependent on this business to pay myself, which means every pound stays in the machine. We can constantly reinvest, which gives me an edge and allows us to grow this much quicker. In terms of how we want to scale this business, well, I think about property as 3 bottlenecks. So this is kind of diving into the strategy in a little bit more. And a business can only grow to being as big as its nearest constraint. And I see that there are 3 main constraints in building a property business. Some would argue there's 1 or 2 more, but for the sake of keeping things simple, I've broken them down into acquisitions. So you need deals. You need to have what we call deal flow. You need to have good opportunities landing on your desk and in your inbox that make sense, that you can go out and make offers on and acquire. Because if you don't have any deals, if you don't have any opportunities, you just don't have a property business. Full stop. It's a non-starter. And so we need to build an acquisition machine. We need to build a machine where we can have good, high quality deals that match our investment criteria landing on our desk that we can pull the trigger on. The second thing is you need capital, because of course you can have all of the best deals and opportunities landing on your desk that make sense, that are profitable, that have got juicy profit margins. But if you don't have the capital to fund these acquisitions, then again, it's a non-starter. You don't have a property business. And then the third thing is you need good delivery and operations. So being able to deliver the projects and manage the projects and run the business, because again, you can have the best deals land on your desk. You can have all the capital you need to go and fund these deals. But if you don't have the right team in place to help deliver and manage the conversions and everything else, well, then it's quickly going to become a lot of chaos. It's not going to be a fun business, and things are going to start to go wrong. So how are we kind of working to unlock these constraints? Well, if we start with acquisitions, simple terms, in short, we're looking to just increase our deal flow through building relationships with agents, which we have already. We have good relationships with certain agents in our target investment area that are feeding us the deals. We'll begin to work with sources. Now, property sources, it's a bit of a wild west. There are some cowboys and there are some really good sources. And so we'll begin to kind of filter out and work with maybe 1, 2, 3, a small handful of sources that understand what we want, how we work, and build good relationships with them. And then as we kind of get a bit more dialed in with the type of stuff we like, we don't like, and we've got through and delivered and exited a handful of deals, then we will start to do some direct to vendor stuff as well, which is something that ramps up pretty slowly. Direct to vendor, it's a volume game and it's also a bit of a time game as well. It takes a little bit longer to get the traction with that, but it's something that we'll start to build out in the background, but not a main focus right now. And eventually we'll begin to hire an acquisition team. So this might be 1 team member. It might even be 2 or even 3 team members. It might be someone working obviously on the ground in the UK here, but supported by 1 or 2 virtual assistants that can help with analysis, etc. And this team will be funded by acquisition fees and rental income. So without going into too much detail of how the deals are structured, but if you look at even the biggest real estate companies in the world, how they structure their acquisitions, etc., and what's very common practice is to charge an acquisition fee. So if we're going and purchasing a deal and we're partnering with a funding partner, a private investor that is looking to partner with us, well, day one on that acquisition, we will be invoicing from our operating company, our holding company, etc., a sourcing fee, which could be 2% of the purchase price. And so if we're buying 2 deals a month, that might be £10,000 worth of acquisition fees, and that acquisition fee income will fund the compensation for the individual, the team that we've built to help with acquisitions. That might be someone with an estate agency background, etc. Someone will have to pour a lot of time and energy into training and refining the systems, but that's ultimately one thing that will really help us scale up on the acquisition side. And then one thing that I don't think is spoken about enough is just having a clear investment strategy and target area. So having what sometimes you hear in the institutional world like a buy box, where you've got a clear criteria of what you want to buy, and if the deal or an opportunity ticks all of those boxes, you pull the trigger and move forward to that acquisition, and not getting shiny object syndrome and jumping around area to area, just having a very clear, defined investment criteria and just focusing on that. That allows you to be hyper focused and makes it easier to filter out what deals you don't want to do and what deals you can actually afford to spend time on. Because one of the big bottlenecks on acquisitions as well is the time it takes to analyze deals, which isn't too long, but when you're looking at a lot of deals, it can quickly add up. So being able to quickly say yes or no allows you to move with a bit more speed in that sense. Big one is capital. So this is probably the biggest constraint for a lot of people, a lot of property businesses that want to scale. And so unfortunately, as you can imagine, your own capital is a finite resource. For me, the capital that I have available, it is a finite resource. It's never going to be enough to do the deals that I want to do. And that is why all of the most successful property entrepreneurs, operators, even the biggest real estate companies in the world, the likes of Blackstone, they work with private investors. They raise capital from private investors. In terms of the structure of how we're going to do this, primarily it's going to be a joint venture equity structure. So we're essentially creating a partnership. We're partnering with an investor and they come in on the deal with us. We may occasionally look to structure it as a second charge loan as well. So the benefit of that is if we come across a deal where the returns, the profit margin is fairly significant, above normal, and we don't feel like we need to give away, let's say 50% of the profits to an equity partner, a joint venture partner, well, then we could have an investor come in, fund the equity piece or the deposit, if you like, with a second charge loan where our cost of capital is going to be lower. It might be 15%, it might be 18%, etc., which is kind of standard in the industry right now for kind of mezzanine or second charge lending. And then we would only do this if we know we have a clear exit, because like with any loan, you need to make sure you've got a clear exit strategy for that loan. So we want to make sure the proceeds from when we refinance, once we've completed the conversion and are looking to exit the investor and the first charge, the senior debt lender, the commercial lender from the deal, we want to make sure those proceeds can allow us to exit that second charge loan with the investor, maybe combined with other income we've got from other deals we've got happening at that time as well. But primarily it will be a joint venture equity structure. And we want to keep a very simple capital stack. So commercial finance for the senior debt. So the majority of the total cost of a project will come from a commercial, a short-term finance lender, i.e. bridging loan, refurb loan, development loan, etc. And so the investor comes in for the deposit of that, the kind of equity piece that we call it. We will be looking to secure larger funding lines with investors. So instead of raising 50,000, 25,000, 100,000 pound tickets, really probably the minimum investment required to get into the type of projects that would be required, the minimum amount of capital would probably be around 150,000 on the low end. But really the funding lines we're looking to secure is really going to be 500k to £1 million plus. Actually kind of secured and got commitments from some investors already. kind of in that region, £1 million plus as well. And that means we can kind of do multiple projects with each investor. We can set up a company, partner with them, and then get into multiple deals, recycle that capital through deals, and then co-own the assets long term. So they benefit from the new equity we've created, the capital appreciation, the income it's producing, etc. And then the main way to attract this capital and these funding partners, people that want to partner with us, is through content and media. So like I alluded to at the very start of this video, I'm a big believer that attention is one of the most valuable currencies. And if you can build an audience of people that know, like, and trust you, then there is a huge amount of opportunity that comes downstream from that. So primarily we're going to be creating content and media documenting this journey on YouTube and Instagram, sharing insights into behind the scenes of the business, deals we've acquired, what's going on, and just really document this journey as transparently as possible. And the way I think about social media and creating content is when you're creating content, you're putting videos out there, you're creating what we call digital assets that are working for you 24/7. Because what we're optimizing for is building trust. For someone to come in and park their hard-earned money with you and partner with you on a project, that takes a lot of trust. Trust is built in a few different ways through kind of the credibility and track record, but one way trust is built is through time spent with each other. And if you have content and media that's been put out, that is a way someone can spend time with you without you necessarily having to spend extra time yourself. I can create a 30-minute, 1-hour digital asset once, but that can get watched and have 10,000 watch hours, which is pretty wild. And so I think about kind of creating these digital assets in two ways. One, it brings in a new audience because the algorithms on YouTube, Instagram, and all these social media platforms are so powerful. It puts the content under the nose of people that think it'll be useful for. But the second way I think about content, which I feel like a lot of people disregard, but it's probably more powerful, is that it nurtures existing relationships that you've developed and maybe built or started offline. So for example, I've met people at the bar on a Emirates flight to Dubai in first class, or in the sauna at my gym, or at a networking event, or sometimes just at the traffic lights, or I'm in my car at a neighbor or something, where I meet them offline. There's a connection that's then created. And I also, let's connect on social media. And so I meet them once, but then they're seeing my content, what could be every day, every week for months. And so the next time we connect, they feel like they know me a lot more, they trust me a lot more. And so it means doing business together becomes a little bit more effortless. And so I think one of the best ways to think about creating content is just to nurture those existing relationships that you have to build trust. And obviously, of course, I'm still going to go out and have the coffees and have the dinners and meet people in person. But it means when we do that, they're going to be much warmer. They're going to have a much better insight into who we are, our business, the type of projects we're doing, etc. And then also we'll host kind of investor days and project tours as well, where we'll invite people that are interested in partnering with us or want to explore partnering with us, walk them through a few of our projects, help them meet the team, meet us, so they can make a much more informed decision if this is something they want to move forward with. But this is huge for us. I strongly believe, I have a lot of conviction that the media we're going to create is really going to help us to unlock this bottleneck. Like I say, we already had commitments of decent chunks of capital, so that gives us good traction to start with. And then the more content we create, the flywheel effect kicks in of attract more capital, do more deals, which means maybe more attention on social media, and then of course more capital, etc. So I'm all about kind of creating flywheel effects in business. And then thirdly, delivery and operations. So really this is, once you have the deals, you have the capital you funded, well, there's a lot of then work that needs to be done to actually deliver these projects in a perfect world on time and on budget. And so the plan is, of course, I've got my business partner, Jamie, who is really going to be taking ownership over this side of the business. He's going to be responsible for project managing and the construction side, and he has skin in the game as well. So yes, he's going to be earning an income as project manager, etc., but ultimately he's got a piece of the upside. And I love Charlie Munger's quote. So Charlie Munger, who was Warren Buffett's business partner, he was actually a property developer before he worked with Warren. And one of his famous quotes is, if you show me an incentive, I'll show you an outcome. And when people on your team are very well incentivized, you get much more from them. You get their full life force. And I was at dinner last night with a very successful entrepreneur, and he said the same thing to me. He said, Tyler, if you give someone strong enough incentive, you get the human, you get them. They're willing to go all in and go with you. So on the delivery side, I've got incredibly talented partnership there. Building clear systems and processes is going to be key. We don't want to become a contractor. I am not a fan, or I've got a lot of friends and people in my network that run successful construction businesses, and it just seems like they have a love-hate relationship with their business. They can be very lucrative, but they come with a lot of complexity, a lot of stress, etc. And we want to keep this relatively simple business. So we are not going to become a contractor ourselves, but what we would like to do is build a good relationship with a contractor that has aligned ambitions. So a contractor that we have a good relationship with, that understands what we're doing, where we're going. And if they have similar ambitions to kind of grow their business alongside that, well, then we could create some kind of partnership or relationship dynamic that works well. Having a good operational team, so that could be an operations assistant that helps maybe on the acquisition side of progressing things through legals, making sure the banks have everything in terms of the documents they need for the application of the bridging finance, making sure we've got the right insurances in place, all the way through to the right licensing requirements for HMO, and it's all stored in the right places. So some kind of operations assistant that can handle all of the administrative stuff. Finance team as well. So within my businesses or ecosystem of businesses already, I've got me as the business owner, and then a trio of the tax accountant who's responsible for all the tax accounting and filing. I've got a part-time finance director whose main responsibility is, I guess, advising me, communicating with the accountant, making sure they have everything they need, and then a bookkeeper whose job is to make sure we've got clean financial records, everything reconciled and up to date, and providing clear reports so we can make data-driven decisions, and of course report on progress to our other stakeholders as well. Property management, I mean, in the short term, we will just outsource the property management to kind of a third-party management company. Eventually, we'll get to a point where the cost of doing that will be more than what it would cost to just hire somebody in-house. And so at that point, we'd look to make that decision. But until then, again, we want to keep it a very simple and a lean business. So yeah, I'm excited to do this. I've got a lot of people in my network and friends already that have very successful businesses. I'm a big fan of a friend, Ryan Beaumont, in the north of England. They do a lot of very impressive business, do a lot of acquisitions with HMOs. And one thing that Ryan said to me in a presentation he did once at a mastermind was that he's basically trying to build his property business into a production line. As well as my friend Jack Jiggins, very successful business as well. They have an unbelievable acquisitions machine as well, and a few other people as well. So I'm going to be maybe creating content with them. If you guys are listening and you're down, then would love to kind of share more about the behind the scenes of your businesses, continue to learn from those around me and share what I learn. So a couple of things before we wrap up. If you would like to express an interest in partnering with us on a project or projects, there'll be a link to a form in the description where you can do that. And then any questions you guys have about this business, feel free to drop in the comments and I'll answer them in future videos. And feel free to point things out, maybe any blind spots or areas you think we could improve, any ideas you think you have. Another part of the reason I'm doing this is to get advice and to attract people that are steps ahead of me, that have figured out things out that we're yet to figure out. But we've got a very clear idea on what we're doing, got some good traction already. Looking forward to documenting this. And as always, see you guys in the next video.